The global oil market has been shaken to its core by a recent and unprecedented action: the United States' seizure of Venezuelan oil assets and tankers. This event, while rooted in decades of geopolitical tension, has triggered a domino effect with far-reaching consequences, sending shockwaves through international markets and potentially laying the groundwork for what analysts are calling a $3 trillion global crisis. To understand the gravity of this situation, it is crucial to examine the context behind the seizure, the mechanics of Venezuela's oil industry, and the reactions from major players on the world stage. Venezuela, a country endowed with some of the largest proven oil reserves in the world, has long been a critical supplier in the global energy landscape. For decades, Venezuelan crude has flowed to markets across the Americas and beyond, supplying refining hubs in the United States, Europe, and Asia. However, internal mismanagement coupled with severe international sanctions has crippled the country's production capacity. Once producing over 3 million barrels per day, Venezuela now struggles to maintain even a fraction of that output. The U.S. seizure adds yet another layer of disruption to this already fragile ecosystem. The immediate spark for the crisis was the interception of multiple Venezuelan-linked oil shipments by the U.S. Coast Guard and military forces. These seizures, which included vessels flagged under Russia, were justified by American authorities on the grounds of sanctions violations. While sanctions enforcement is not new, the scale and aggressiveness of these actions have been unprecedented. By physically taking control of oil assets on the high seas, the U.S. has escalated a legal and geopolitical confrontation, signaling a readiness to use force to protect its strategic energy interests. This marks a stark departure from previous sanctions, which typically relied on financial restrictions rather than direct intervention. The consequences of this intervention are multifaceted. First, global oil prices, which have already been volatile, experienced a sudden spike. Market participants are recalibrating risk premiums, anticipating further interruptions in Venezuelan exports. Crude oil benchmarks like Brent and WTI saw rapid fluctuations, reflecting both the uncertainty of supply and the broader fears of escalation in geopolitical tensions. Traders and energy companies are acutely aware that even temporary disruptions in Venezuelan output can create ripples across the global economy, affecting everything from transportation costs to heating oil prices. Beyond the financial markets, the seizure has profound implications for global geopolitics. Venezuela's oil has historically been a strategic lever, allowing the country to exercise influence in regional and international politics. By seizing these assets, the U.S. effectively undermines the Maduro government's ability to wield oil as a diplomatic tool. This move has provoked strong reactions from countries allied with Venezuela, including Russia and China, who see the intervention as a direct challenge to international norms. Diplomatic tensions are rising, and experts warn that these confrontations could spill over into broader economic sanctions or even military posturing, further destabilizing an already fragile region. The internal Venezuelan response is equally critical. For a country struggling with hyperinflation and economic collapse, oil revenue is the lifeblood of the economy. The seizure exacerbates domestic hardships, threatening jobs, government programs, and basic social services. While Maduro's government has claimed it can continue exporting oil, the practical reality is that operational control over shipments and infrastructure has been compromised. The uncertainty surrounding access to markets has also led to internal financial panic, with Venezuelan banks, corporations, and citizens facing increased risks from currency fluctuations and restricted liquidity. Another dimension to consider is the impact on global energy strategy. The United States, by controlling Venezuelan oil shipments, not only influences supply, but also sends a message to other oil-producing nations about the limits of autonomy in international trade under U.S. policy. Countries reliant on energy exports are reassessing their risk exposure and contingency plans. This shift could accelerate investments in alternative energy sources, strategic petroleum reserves, and diversified supply chains. Ironically, the seizure, intended as a tool of leverage, may inadvertently encourage competitors and allies alike to reduce dependence on U.S.-dominated markets, reshaping global energy politics for decades to come. Moreover, financial institutions around the world are recalibrating exposure to Venezuelan and related assets. Banks, hedge funds, and investment firms that hold stakes in oil ventures linked to the region face mounting uncertainty. Credit ratings are being adjusted, insurance premiums on oil shipments are rising, and long-term investment decisions are being deferred. Economists warn that these adjustments, while measured in individual transactions, collectively amount to significant global economic contractions. This financial chain reaction is part of why some analysts estimate that the total impact could reach trillions, affecting investment flows, sovereign debt stability, and currency valuations on a global scale. The crisis also highlights the intersection of energy security and legal ambiguity. While the U.S. claims the authority to seize assets under existing sanctions, Questions remain about the legality under international maritime law. Legal scholars have debated whether such actions constitute a violation of sovereign rights or set dangerous precedents for international commerce. This uncertainty complicates not only diplomatic negotiations, but also practical business operations. Oil companies, shipping firms, and multinational corporations must navigate a precarious legal environment, which increases costs and reduces predictability in the global market. In conclusion, the U.S. oil seizure in Venezuela is more than a headline. It is a pivotal event with cascading effects across energy markets, geopolitics, domestic economies, and global finance. While the immediate outcomes are visible in oil price volatility and diplomatic protests, the long-term ramifications are far-reaching, potentially setting the stage for what could be termed a $3 trillion global crisis. Understanding this event requires not just following the news, but analyzing the structural vulnerabilities in international energy dependence, the strategic ambitions of major powers, and the fragile state of the Venezuelan economy. As this situation continues to unfold, its consequences will likely redefine the rules of global oil politics for years to come. The U.S. seizure of Venezuelan oil has triggered a complex web of economic consequences that extend far beyond the immediate volatility in crude prices. While headlines focus on political tensions and maritime confrontations, the real story lies in the subtle yet profound shifts occurring in global finance, trade flows, and investor confidence. These shifts, if left unchecked, could culminate in a financial storm affecting trillions of dollars worldwide, illustrating how interconnected energy markets and global economies have become. One of the most immediate economic effects has been the surge in oil prices. Crude oil, the lifeblood of global commerce, is traded on multiple exchanges, including Brent and WTI benchmarks, and any disruption in supply reverberates instantly across these platforms. Following the U.S. intervention, oil prices jumped sharply as traders recalculated risk and projected potential shortages. Even temporary disruptions in Venezuelan production, one of the world's largest oil reserves, carry enormous weight. Shipping routes, tanker capacities, and refining schedules are all sensitive to small changes in supply, which amplifies price fluctuations. For countries dependent on imported oil, these price shocks translate directly into higher transportation, manufacturing, and energy costs. The impact is particularly acute for emerging economies that rely heavily on imported energy. Nations in Latin America, Africa, and Asia are experiencing rising inflation as fuel prices escalate. Higher energy costs ripple through the cost of goods and services, from agricultural production to industrial manufacturing. These economies, already vulnerable to debt pressures, face the added strain of increased import bills and currency depreciation. Analysts warn that prolonged disruption could trigger recessionary pressures in multiple regions simultaneously, contributing to what some experts describe as the foundation of a multi-trillion-dollar global crisis. Financial markets have not been immune. Investors, responding to uncertainty, are shifting capital toward perceived safe havens such as gold, U.S. treasuries, and select currencies. Conversely, emerging market bonds, particularly those linked to energy-dependent economies, are experiencing widening spreads and reduced liquidity. Hedge funds and institutional investors are reassessing their portfolios, adjusting exposure to oil futures, Venezuelan-linked assets, and geopolitical risk zones. The combined effect is a cascading series of market reactions, with the potential to affect stock indices, corporate borrowing costs, and sovereign credit ratings around the world. In aggregate, these financial disturbances could easily reach trillions in value, reflecting the highly interconnected nature of modern global markets. Insurance and logistics sectors are also feeling the shockwaves. Shipping insurance premiums for oil tankers and cargo have surged following the U.S. seizure, reflecting the higher risk of interception or legal disputes on international waters. Companies involved in the transport of energy commodities are forced to reroute shipments, sometimes at significant cost, to avoid areas deemed high risk. This not only raises the cost of oil, but also disrupts the supply chain for other critical commodities, such as natural gas and petrochemicals, which are closely linked to oil production. The knock-on effect is a ripple through global trade, affecting everything from industrial production in Asia to heating fuel in Europe. Energy-dependent corporations are recalibrating strategies in real time. Refining companies that rely on Venezuelan crude are scrambling to secure alternative supplies, while national oil companies are renegotiating contracts with foreign partners. Even companies with diversified portfolios face increased operational risk and uncertainty in financial planning. For instance, long-term contracts priced at lower fixed rates may suddenly become loss-making due to elevated spot prices. Such disruptions can reduce profitability, trigger cost-cutting measures, and ultimately impact employment and production in multiple regions, demonstrating how a localized geopolitical action can generate worldwide economic tremors. The ripple effect extends to international currency markets as well. Petrocurrencies, currencies of oil exporting nations like the Russian ruble, Canadian dollar, and Venezuelan bolivar, experience volatility tied directly to crude pricing and market confidence. For Venezuela, the seizure has accelerated depreciation of the bolivar, undermining domestic purchasing power and complicating government efforts to stabilize the economy. For other nations, currency fluctuations create uncertainty in trade contracts and cross-border investments, further amplifying financial instability. Central banks may be forced to intervene, raising interest rates or adjusting foreign exchange reserves, which introduces additional pressure on global financial systems already strained by inflation and debt burdens. Global energy strategy is undergoing a profound reassessment. Countries that rely heavily on imported oil are exploring contingency plans, including stockpiling strategic reserves, investing in alternative energy, and diversifying trade partnerships. This shift, while prudent from a security standpoint, may disrupt long-standing supply relationships and trigger competitive tensions between nations. Oil importing countries may accelerate renewable energy projects, electric vehicle adoption, and natural gas infrastructure development to reduce exposure to geopolitical risk. Ironically, these measures, aimed at mitigating immediate economic pain, can create longer-term market upheaval as traditional oil suppliers face reduced demand and new competitors emerge. Political and fiscal implications are equally significant. Governments worldwide are being forced to adjust budgets in response to rising energy costs. Subsidies for fuel, electricity, and transportation may need to be increased to prevent social unrest, while higher energy bills strain public finances. For countries already struggling with debt or fiscal deficits, these adjustments are particularly challenging. Social programs, infrastructure projects, and healthcare funding could face cuts or delays, compounding economic pressure and creating domestic instability. The interplay between economic policy and geopolitical events thus becomes a critical factor in determining the extent of the global crisis. Legal uncertainty adds another layer of complexity. International law regarding the seizure of foreign assets, maritime rights, and sanctions enforcement is highly contested. While the U.S. argues that its actions are legitimate under sanctions regimes, other countries view them as violations of sovereignty and maritime law. This legal ambiguity affects multinational corporations that operate in energy markets, as the risk of litigation or asset confiscation increases. Legal disputes can slow or halt investment, further exacerbating market uncertainty and amplifying the financial impact. Finally, the human and social dimensions cannot be ignored. In Venezuela, the immediate economic fallout translates to higher unemployment, reduced access to essential goods, and escalating poverty. Globally, energy price spikes and financial market disruptions indirectly affect millions, raising the cost of living, limiting economic mobility, and increasing inequality. While some of these effects are diffuse, the scale is massive, reinforcing the argument that the crisis, although sparked by a single geopolitical action, has consequences that ripple through the entire global system. In summary, the U.S. seizure of Venezuelan oil has set in motion a chain reaction with profound economic consequences. From fluctuating oil prices to currency volatility, from trade disruptions to shifts in energy policy, the effects are widespread and complex. Financial markets, corporations, governments, and ordinary citizens are all affected in different ways, yet their experiences are interconnected through globalized trade and finance. These cascading effects, reaching across continents and industries, underscore the potential magnitude of the crisis. If unresolved, these disturbances could contribute to an economic shock measured in trillions, demonstrating how a single, strategically executed intervention in the energy sector can reshape the global financial landscape. As the immediate shockwaves of the U.S. seizure of Venezuelan oil begin to ripple through global markets, attention is shifting toward the long-term consequences. Unlike short-term price fluctuations or temporary supply disruptions, the strategic implications of this action are likely to reshape global energy policy, international finance, and geopolitical alliances for years to come. Analysts are warning that the world is entering a period of heightened uncertainty, where energy security, diplomatic relations, and economic stability are more tightly intertwined than ever before. One of the most significant long-term effects is a permanent recalibration of global energy supply chains. Nations that have historically depended on Venezuelan oil are now exploring alternative sources, diversifying imports, and accelerating investments in domestic energy production. Countries in Europe and Asia, for example, are negotiating new agreements with Middle Eastern and African oil exporters, seeking to reduce vulnerability to U.S. interventions or geopolitical disruptions. Simultaneously, renewable energy projects are receiving unprecedented attention and funding, with solar, wind, and nuclear energy seen as strategic buffers against future oil-related crises. In essence, the seizure acts as a catalyst, forcing governments and corporations to rethink energy dependence and plan for resilience in an unpredictable world. The financial markets are also bracing for long-term disruption. Investment patterns are shifting, with capital flowing towards sectors perceived as insulated from geopolitical risk. Energy infrastructure, global commodities trading, and insurance markets are adjusting to a new reality where interventionist policies can alter trade flows almost overnight. For multinational corporations, this means reassessing supply chains, hedging strategies, and credit exposure. Financial institutions are also reconsidering their engagement with countries susceptible to sanctions or military interventions, leading to tighter lending conditions, higher insurance premiums, and reduced liquidity for certain markets. These shifts, while precautionary, have the effect of slowing global economic growth and creating uncertainty that can ripple through multiple sectors simultaneously.